Are you scared of investing your hard-earned dollars and kickstarting a new financial venture? Today, we are going to share a 5-year investment plan and how to build assets with smart investing. We all can relate to the financial risks when it comes to investing our money. But tucking your dollars in a bank won't make you lasting wealth. Making smart investment decisions will. Investing in the right places increases your reward factor and reduces your risk factor. So there is no reason why you shouldn't be investing your money. If you don't know where to start, we have got you covered. In this video, we will be sharing an effective 5-year investment plan that will reward you in the upcoming years and tell you how to build assets with smart investing. Get ready, as we are going to reveal some golden tips about financial planning. By the end of this video, you will not only master how to make an effective investment plan, but you will be empowered to set yourself up for financial success. So, without any delay, let's dive deeper into the most valuable investment lessons. Don't forget to hit the subscribe button because you don't want to miss any tip that could shape your financial life. Let's begin by discussing why you should create an investment plan. You might have probably heard that debate of saving versus investment in the financial circles. So before you even begin building your investment plan, it is important to answer this important question. You need to understand why you need an investment plan in the first place. Does it really help you? Consider the example of our imaginary character, Alex, a young professional in his mid-20s who just started their career. Alex has some money saved up and is contemplating the best way to use it. He's torn between two options. Option A is to keep the money in a regular savings account, and option B is to create a structured investment plan. Alex decides to keep his money in a regular savings account. The account offers a modest interest rate, and Alex can easily access their funds whenever needed. Over the next few years, the money remains relatively stable, but the interest earned is minimal. Alex doesn't actively track inflation rates or consider the impact of taxes on their savings. Fast forward 5 years, and Alex realizes that the purchasing power of his money has decreased. Inflation has eroded the value of the savings, and the interest earned hasn't kept up. The opportunity to grow wealth over time was missed, and Alex wishes he had considered a more strategic approach. On the other hand, Alex decides to create an investment plan. He assesses his financial goals, risk tolerance, and the time horizon for their investments. With a clear plan in place, Alex diversifies his investments, including a mix of stocks, bonds, and other financial instruments. Over the same 5-year period, Alex's investment plan sees a more substantial increase in value compared to the stagnant savings account. The diversified portfolio helps mitigate risks, and even during market fluctuations, the overall trajectory is positive. Alex takes advantage of compounding returns, allowing their money to work for them over time. When Alex reviews his financial situation after 5 years, he is pleased to see that the investment plan has not only preserved the value of his money against inflation, but has also generated additional returns. That's why you need an investment plan to have long-term financial stability. Having an investment plan is like building a financial safety net, and it serves as a crucial pillar of financial security for the future. A well-funded retirement account ensures that you and your family can maintain your desired lifestyle even after you stop working. Imagine your finances as a thrilling road trip, and the 5-year financial plan, well, that's your trusty GPS. Buckle up for a journey where your dreams are the destination. Think of it as a friend who whispers, "Maybe skip the fancy coffee today?" A financial plan helps you make smart money moves, so you're not stuck with only loose change at the dream house's doorstep. Your financial plan is your progress bar, showing you how close you are to leveling up in life. Making a plan is like Harry Potter's spell for financial discipline. It's not about restricting, but about channeling your money wizardry to make it work for you. So, grab your financial wizard hat, cue the adventure music, and let your 5-year plan turn your financial journey into the blockbuster of your life. Now, let's move towards evaluating your present financial situation, which is the most important step to create a 5-year investment plan that can help you build assets. The first step in creating a smart investment plan is understanding where you stand financially right now. Imagine it like this. Before deciding what to cook for dinner, you need to know what ingredients you have in the kitchen. So let's talk about money. Start by figuring out how much money you can set aside for investing. A helpful way to do this is by making a budget. Think of your budget as a map that shows where your money is going each month. It's like planning your spending, so you know how much you have left. Consider your monthly income first. This is the money you bring home after taxes. Now, subtract your regular expenses like rent, groceries, and bills. What you have left is your disposable income, the money you can decide to save or invest. But hold on. Before jumping into investments, it's wise to have some emergency savings. Imagine it's like having a spare tire for your car. It's there just in case something unexpected happens, like a flat tire or a sudden expense. Once you've set aside some money for emergencies, you can see how much of your disposable income is ready to go into investments. Imagine you have $1,000 to invest, and you anticipate a potential need for the money in a few months. Now, let's talk about how quickly you might need your money back. Your investment is like a piggy bank. If you think you might need to crack it open in a hurry, you'd want your money to be easily accessible or liquid. For example, stocks are like quick-to-crack piggy banks. You can sell them and get your money relatively fast. On the other hand, real estate is more like a big safe. It takes more time to turn into cash. So, think about your plans. If you're saving for a dream vacation next year, you might prefer the quick-to-crack piggy bank. But if you're thinking about buying a house in a few years, the big safe could be a better fit. Understanding your current financial situation and thinking about how fast you might need your money, that's like setting the table before you start cooking up your investment plan. Now let's talk about risk tolerance and time horizon, which is the most important step to create a 5-year investment plan that can help you build assets. Crafting your investment plan involves 2 critical considerations: determining your risk tolerance and defining your time horizon. These factors play a crucial role in creating a strategy that aligns with your financial goals. Firstly, let's talk about risk. Generally, the younger you are, the more risk you can afford to take. It's like having a longer recovery time for your portfolio to bounce back from any setbacks. On the flip side, if you're older, it's often wiser to opt for less risky investments and invest more upfront to stimulate growth, as you may have less time to recover from potential losses. Riskier investments come with the promise of significant returns, but they also carry the potential for major losses. It's akin to taking a chance on a stock or a piece of land. It could yield substantial profits, or you could face a loss. If your goal is to build wealth over the long term, a safer investment path might be more suitable. Now let's talk about the time horizon. Simply put, it's when you plan to start tapping into your investments to achieve your ultimate financial goal. Think of it as planning a surprise party. The longer you have to prepare, the more extravagant and exciting it can be. Retirement is like the ultimate surprise party, and your time horizon is when you want to reveal the grand celebration. By understanding both your risk tolerance and time horizon, you can create a robust asset allocation. This involves tailoring your investment mix based on your investor profile and determining the percentage of your overall portfolio each investment type should occupy. All right, now let's talk about the next step in create a 5-year investment plan that can help you build assets. That is, starting early investment. Research consistently shows that, on average, investors who might not have perfect timing still earn twice as much as those who kept their savings in cash-like investments over a 20-year stretch. And here's a fascinating tidbit. Those who stuck to their investment plan ended up with a higher net worth than those who didn't. So, what's the secret sauce? Well, there's no magic formula. It's all about time, discipline, and having a solid investing strategy. Think of it like a marathon, not a sprint. Getting started earlier is like giving yourself a head start in the race. The longer you're in the game, the more you benefit from something called compounding returns. It's like the snowball effect. The more it rolls, the bigger it gets. Now, here's a nugget of wisdom backed by data. Sticking to your plan and continuing to invest, no matter what the market is up to, tends to lead to more wealth in the end. It's like weathering storms. You might get a little wet, but you'll likely see brighter days ahead. Consider the story of one of the world's top-notch investors, Jesse Livermore. Despite lacking formal education in stock trading, became a self-taught success story. Learning from both wins and losses, his experiences laid the foundation for timeless trading principles still applied today. Picture this, a teenager diving into trading, and by 16 he's already raking in over $1,000. Major moolah back then. Livermore's early victories came from outsmarting bucket shops, places where people bet on stock moves rather than legit trades. So Livermore's journey, like a stock chart, ups and downs, but his lessons are still the heartbeat of today's market. Talk about turning teenage hustle into timeless trading wisdom. Whether you're a beginner in the investing realm or contemplating adjustments to your existing plan, remember this: just showing up is half the battle. Even if you don't nail the perfect investments at the perfect time, and who does, you're generally better off actively participating in the game rather than watching from the sidelines. So in a way, just like in sports, the key is to get in the game, because being in the action usually leads to more success than sitting it out. So lace up your financial sneakers and get in the game. By the way, if you're enjoying the video so far and want to enjoy more topics like this, comment the word "more" so I know. Now let's talk about another essential step in create a 5-year investment plan that can help you build assets, that is, making consistent investments. Investing sporadically or just once a year might not cut it if you want your money to flourish. To give your money the best chance to grow, it's crucial to invest a set amount regularly. Whether it's each month or every quarter, this financial discipline is like watering a plant regularly. It helps your wealth blossom and reach your financial goals. To make this process smoother, think of it like putting your investments on autopilot. Consider using systematic investment plans, SIPs, or auto payment options. These tools ensure that a fixed amount is deducted from your account like clockwork each month, without you having to remember or worry about it. It's like having a reliable gardener who waters your financial garden regularly, helping your investments thrive consistently. So, remember, the key is to stay consistent and disciplined with your contributions. Just like tending to a garden, regular care leads to a more fruitful harvest in the long run. Whether it's SIPs or auto payments, find a strategy that works for you and watch your financial garden flourish over time. All right, now let's talk about another step in create a 5-year investment plan, that is, creating a diverse portfolio, that is, making consistent investments. Imagine your investments are like a team of players in a game. Now, you wouldn't want all your players to be experts in just one skill, right? The same goes for your money. Don't put all your financial hopes in one basket. It's an age-old saying that still rings true. Never put all your eggs in one basket. Here's why. Diversifying your investments is like having players with different skills on your team. If one player has an off day, others can step up and keep the game going strong. In the financial world, this means spreading your money across different types of investments, like stocks, bonds, and real estate. It's a smart move to help manage risk and avoid heavy financial losses, especially when the market gets a bit wild. Let's talk real life. Consider Serena, a tennis professional who knows the importance of having a diverse set of shots on the court. She doesn't rely solely on her powerful serve or precise backhand. Instead, she mixes it up to stay ahead of the game. Similarly, in the financial game, having a diverse portfolio is your way of mixing up your shots to navigate the ups and downs of the market. Remember the COVID-19 pandemic? That was a game changer for the economy. Investors who had all their money in just one type of stock found themselves in a tough spot. But those who spread their investments across different areas faced the storm with more resilience. It's like Serena, having a variety of shots to handle different opponents. Being versatile pays off. So take a cue from Serena. Diversify your investments like she diversifies her shots. Your financial game plan becomes more robust, and you're better prepared for whatever the market serves up. Now let's move towards the power of compound interest, which is another important step to create a 5-year investment plan that can help you build assets. Think of time as your secret weapon in the world of investing. It's like having a magic ingredient that can significantly boost your financial gains. Here's the trick. Don't just invest and pocket the returns. Reinvesting, the interest is where the real magic happens. Let's break it down. Say you invest some money and it earns interest. Now, instead of just spending that extra cash, reinvest it. It's like planting seeds that grow into more money trees. This process is called compound interest, and it's a powerhouse when it comes to building wealth. Imagine this scenario. You invest $100 and it earns you $5 in interest. Now, instead of taking that $5 and treating yourself to a cup of coffee, you reinvest it. Now, not only is your original $100 working for you, but that extra $5 is too. The next time you earn interest, it's calculated on the bigger amount, both your initial investment and the interest you've already earned. It's like a snowball rolling downhill, gathering more and more snow. Now, let's add the element of time. The longer you let this process play out, the more impressive the results. It's like watching your money grow on its own. Consider Alex, a fictional character who understood the power of compound interest. Instead of just spending the extra money earned from investments, Alex consistently reinvested it over the years. As time passed, the wealth snowball kept getting bigger, and Alex ended up with a robust financial portfolio. So remember, time is your ally. Don't just let your money work for you by harnessing the power of compound interest. It's like having a financial growth spurt that can lead to significant wealth over time. Now let's talk about not falling for the highest returns, which is the most important step to create a 5-year investment plan that can help you build assets. Imagine racing in a marathon rather than a sprint. The goal isn't always to chase the highest returns in the shortest time. Just like a marathon, smart investing often involves making steady and low-risk choices over the long haul. It's like planting a tree. You don't expect it to grow tall overnight. You patiently nurture it, knowing it'll provide shade for years to come. Here's the key. Successful investing often means prioritizing consistency and patience over quick gains. Think of it like tending to a garden. You don't just toss all your seeds into the ground and expect a lush garden the next day. It takes time for your investments to grow and bear fruit. Consider Emily, a savvy investor who didn't get swayed by the allure of quick wins. She opted for low-risk investments and played the long game. Instead of trying to time the market for short-term gains, she focused on building a stable and enduring portfolio. As time passed, her investments steadily grew, creating a financial landscape that stood the test of time. So if you're aiming for lasting financial success, think of it like nurturing a slow-burning fire rather than chasing a fleeting spark. Low-risk, steady investments over the long term often lead to the most rewarding outcomes. It's not about the speed of the race. It's about crossing the finish line with a flourishing portfolio. All right, let's move towards not following the crowd blindly, which is the most important step to create a 5-year investment plan that can help you build assets. Picture this. You're at a financial crossroads, and everyone's marching in one direction like they just found a treasure map. It's tempting to join the parade, right? But hold your horses. Benjamin Graham, the financial sage, once said, "Even the smartest investors need willpower to avoid herd mentality." It's like trying to resist buying that extra pair of shoes on sale, challenging but crucial for your financial sanity. Now let's imagine your financial journey as a road trip. You're in the driver's seat, and everyone's pointing towards a dazzling shortcut. But wait, your GPS is saying something different. Your risk tolerance, wealth vision, and family needs are like the navigation system guiding you. It's a personal journey, not a caravan to the same destination. So resist the urge to follow the crowd blindly. They might be heading to a surprise party, and you've got a dinner reservation elsewhere. And now, for a financial chuckle, why did the investor bring a telescope to the financial seminar? That's because he wanted a closer look at their future returns. Remember, in the financial forest, Each tree is different, and blindly following the crowd might lead you to the wrong picnic spot. So stay true to your financial compass. Make decisions that suit your unique goals, and who knows, maybe you'll find the financial equivalent of a pot of gold at the end of your chosen rainbow. Taking the time to understand your own financial landscape and making decisions based on your individual goals is like having a personalized map for your financial journey. It's about navigating your way, not following the footsteps of others. Now let's talk about another vital step to create a 5-year investment plan, that is, monitoring and rebalancing your investments. Think of your investments like a team. You want each player to perform at their best. Checking in on your investments regularly is like being the coach, making sure everyone is playing their part. Now let's say you know a player, let's call them Stock Star, who is scoring way more goals than the others. It's great for Stock Star, but your team's balance is off. This is where rebalancing comes in. You might decide to bring Stock Star down a notch and give other players like Bond Buddy or ETF Expert a chance to shine. It's like making sure everyone gets a fair shot at the game, creating a more well-rounded and resilient team. And hey, life happens. Maybe you started with a game plan, but now your goals have evolved. Let's say your dream was a beach house, but now you're eyeing a mountain cabin. Your financial playbook needs a tweak. This is when you might want to shift your money into more stable investments, like a mountain cabin fund, as you approach your goal. On the flip side, maybe you're doing even better than expected. You've got your eye on an upgraded dream, a private island, perhaps. Now you might decide to take on more risk, like investing in adventure ventures, to reach that dream sooner. So think of your investments as players on your financial team. Regular check-ins and rebalancing ensure everyone is playing their role, and you're on track to win the game. It's like managing a fantasy league, but with real money and real dreams. Now let's talk about another step to create a 5-year investment plan that can help you build assets. That is, patience is the key. Let's lean on the wisdom of a good old proverb: good things come to those who wait. This nugget of wisdom is not just for patient folks. It applies to the financial world, too. Many investors are on the hunt for quick profits, but rushing into things can often result in hefty financial losses. Markets can be as unpredictable as the weather. Patience acts as your umbrella during financial storms, helping you ride out the ups and downs without panicking. It's like waiting out a rain shower. You know the sun will eventually come out. Rushed decisions in investing often lead to regrets. Patience gives you the space to carefully research, analyze, and make informed choices. It's like cooking. You wouldn't toss random ingredients into a pot and expect a gourmet meal. You'd take your time to craft something delicious. Patience allows you to learn from both successes and failures. If an investment doesn't perform as expected, patience lets you assess, adapt, and make better decisions in the future. It's like mastering a musical instrument. It takes time and practice to hit the right notes consistently. Imagine Alex, an investor who embraced the waiting game. Instead of chasing after short-term gains, Alex opted for the slow and steady approach. It's like baking a cake. You can't rush the process, but the end result is delicious. So the next time you feel the urge to check your investments every hour or jump on the latest market trend, remember, good things often take time. It's not about the sprint, it's about the marathon. Take a deep breath, let your investments unfold, and watch them grow into healthy profits over the long run. It's the financial version of savoring a fine wine. The longer you wait, the better the taste. So there you have it, a 5-year investment plan and how to build assets. With smart investing that will change the way you think about your finances and empower you to make sound financial decisions. Remember, the key to financial success is to take charge of your finances today. As always, you can enjoy any audiobook for free by clicking on the link below the video. You can also find a list of suggested books and where to buy them below. This video is for educational purposes only and does not constitute investment advice. It is important to conduct thorough research and consult with financial professionals before making any investment decisions. The value of investments can fluctuate, and past performance is not indicative of future results. Always evaluate your risk tolerance and investment goals before allocating your capital. I recommend you watch the next video in our series. If you liked our content, share our video, hit the subscribe button, and share your thoughts in the comments section. Thanks for watching, and I'll see you in another video.